thank you for joining us today, and welcome to another NEO Spotlight, where we ask questions to industry experts and thought leaders about their views and insights and an outlook on upcoming challenges and opportunities. Ultimately, everything of interest to investors, financial advisors, and participants in Canadian capital markets. My name's Eric. I'm our Chief Revenue Officer here at the NEO Exchange. I'm your host today. And the topic du jour is a Canadian classic, the energy transition in transition. I am thrilled to be joined by two outspoken individuals from Ninepoint Partners, headquartered here in Toronto, seemingly on both ends of that transition. Warmest welcome to Eric Nuttall, partner and senior PM of Ninepoint and responsible for the NNRG ETF, and John Wilson, co-CEO and PM, who also manages the Ninepoint Carbon Credit Fund, CBON, both coincidentally listed on the NEO Exchange. Gentlemen, thank you both for joining us and for being a part of the conversation today. Welcome.
Good to be with you.
Yeah, thanks, Eric.
My pleasure. Well, I thought we've got 29 minutes. We've got a massive crowd because you both have a tremendous following and folks who are paying attention to your efforts in markets and your investment philosophies. I thought, John, since we've chatted last with you on the carbon credit side of the business, you were on screen with us a few weeks back to discuss and in fact introduce carbon credits to our investor base. We talked about its evolution, future outlook of the new segment, and quite a bit, frankly, has changed since we had that discussion. So I thought it might be good to start with you on the front end of that transition, talk a bit about the business and the political pulse, shall we say, and where things have evolved since our conversation in March. We're through some uncertainty. We have a view on where the markets are now in March and April. Has your position, in fact, changed on the outlook for carbon markets?
No, not at all. And in fact, if anything, since we spoke last, the underlying fundamentals that support, vibrant and growing carbon markets have just increased. And that's true both in Europe, which is still today the largest functioning electronically traded carbon market, and here in North America, particularly in Canada. So I think since we spoke, the federal government here put out their emissions transition plan, which we can talk a little bit about it. Actually, there's an article in the Globe and Mail on the front page this morning from the environmental commissioner criticizing the government in terms of their steps, in terms of they're not going to make their plan even based on what they've said so far. And that also, we can talk a bit about why we think carbon credits are an important vehicle to help this transition happen. So yeah, if you want, just quickly in Europe, clearly, if you look since the start of the year, well, let's go from February 1st, which is, prior to the Russian invasion of Ukraine. Since that time, this asset class, it's obviously been difficult in bond land. It's actually more recently been very difficult in the equity land, unless you're fortunate enough to be invested with Eric and his energy strategies. But carbon credits themselves have held in really well. The North American credits are up about 6% over that time period. In California and Quebec, the RGGI, which is Northeast US, it's flat. The UK is down about 3%, and Europe's down about 7%. And Europe was down about 35%, and that was a reaction to the war in Ukraine. But it's been uncorrelated from those other asset classes, which is one of the strong characteristics of the asset class. But Europe also put out a big report actually yesterday, looking at the carbon trading market in Europe and underlining, why it has done so well, because it's been a really good performing asset class over the last couple of years. And fundamentally, it comes down to, nothing that should surprise anyone. They've had extreme weather events. There were huge heat waves in Europe last year, which drew more demand for power, which meant that utilities had to buy more carbon allowances, which pushed up the price of these credits. Secondarily, as energy prices have risen, and we'll talk about my belief about some of the causes for that, which is frankly, overreaction by ESG investors and environmentalists on trying to get off oil too quickly. But higher gas prices mean in Europe that they go to coal, which is actually the opposite of what everyone wants. And if you're running a coal utility, you have to buy more carbon credits. So that pushed up the price of carbon. And so, it's just, it all builds on itself. The price of carbon is going to go higher. It's going to get much bigger. We're going to need more industries to put under emission regulation if we want to hit our targets. And that makes this a really compelling long-term investment opportunity.
Thank you for the color, John, and actually incredibly timely set of events over the last 24 hours. I don't think we could have planned a webinar conversation for investors any better on the heels of the report publication in the news, and kind of echoing the thought, the theme yesterday, and I think he followed, Eric, your presence on BNN yesterday. Generally that transition, late, slow, seemingly a bit disorganized on their approach overall. But maybe an interesting segue and transition to bring you into the conversation a bit. What does that delay in the transition journey actually mean from the context of ultimately where you're focused with your business around Canadian oil and gas producers and their ability to drive forward in this current environment?
So what excites me is I think the Ukraine-Russia invasion is offering a teachable moment for energy policymakers with the realization that oil revenue can be weaponized. And so this flaw in logic that the transition is measured in years, and we'll all be driving electric cars in the next 3-4 years, and the oil industry is a sunset industry. You're seeing politicians pivot away from that. I was shocked. I had to watch the interview 4 times. Our deputy prime minister last week saying that Biden killing Keystone XL was a mistake. And so you're seeing a pivot. You're seeing a pivot from energy policymakers realizing that we'll be consuming hydrocarbons, oil, natural gas for the rest of our lifetimes. And there needs to be a change in terms of the support that politicians are offering the sector. So there's no change from my perspective from oil and gas companies. When we look at our oil sands, they've pledged net zero by 2050. It's achievable. The government's outlined the necessary support to allow that. And in the meantime, the sector is experiencing record free cash flows. We just had Cenovus today say that they'll be reaching a debt level so low in the coming months that they'll be returning 100% of free cash flow back to investors, which represents a 30% return. So that's tremendously exciting.
So in fact, what you're suggesting, I know you've long believed in the philosophy and belief that Canadian oil producers are undervalued, and I've heard you talk about free cash flow in the context of our Canadian providers in particular. You actually see the world playing a bit into your hands at the moment with the way things are moving.
Yeah, we've been the biggest proponent of companies returning free cash flow back to investors, moderating, in fact, having no production growth because it's not being rewarded. And so what we're seeing is that philosophy is being widely adopted by industry. It's taken a lot of effort, a lot of time and conversations behind the scenes, but it's exciting because when we look at valuations of companies, there's a simple breakdown. We have stocks trading at 2 times cash flow, and they used to trade at 8. Well, why has there been that multiple compression? It's energy ignorance. This belief that we're all going to be transitioning off of oil in the coming months or quarters, and the peak oil demand is right around the corner, and therefore it perverts people's sense of what should we be paying for barrels in the ground to be used, decades from now. Well, the average guy would say, well, it's worthless because we're not using it because we're all driving electric cars in the coming years. And so it's energy ignorance that is offering still, I think, a generational opportunity. And as people realize that we'll be consuming oil for much, much longer than consensus believes, suddenly there's the necessity to place value on those barrels, the production, that cash flow, that free cash flow, the dividend potential. And so again, when a Cenovus comes out and says 100% of free cash flow going back to investors in literally the next quarter, and people realize that that's 30%, well, that drives the re-rating. It forces people to re-rate a company because you can't trade out a 30% dividend yield for very long.
Makes sense. It's actually a very interesting conversation. I think it's actually very cool that we can have you both here with us today because you both kind of barbell, the future of the world where we're going to go net zero, and you've got a platform upon which to do that. Eric, you're representing where we are today and what you've believed in for a very long time. It's great to have you both in the room together to be able to face off and chat about that journey. And in fact, if I'm interpreting Eric, perhaps your comments correctly, the world has been thinking of this as, we're going to leapfrog and end up in an end state that everything's just going to kind of happen quickly. And in fact, there's a very interesting philosophy or an investment opportunity in that transition itself. And maybe I'd like to put the question back to both of you in due course, but maybe Eric, start with you. You know, the companies are in the midst of preparing for this transition. I know the question you get asked all the time: where are we in this journey? Have we missed it? Is it still in front of us? 2050 is a long way away. How much time do you think investors actually have to enjoy the early stages of this transition and get ready for? John, maybe a question back to you on the end state.
Yeah, so my belief is that the transition that we're referencing is measured in many decades. You know, the reality is we will all be consuming oil for the rest of our lifetimes. You know, as I look around this room, everything is made of or required the use of oil to make it, manufacture it. When we look at the competitive threats to oil, you know, about 60% of oil is used in transportation. So people think about, you know, Tesla and hydrogen, et cetera. Well, the challenge is so massive to displace. Like when we think of just the mathematical challenge of replacing 1.35 billion internal combustion engines when EV sales last year globally were 5 million. You know, so we're talking decades from now. And so when I think about the transition that these companies are in, the reality is the demand for oil is now back to pre-COVID levels and will grow for at least the next 10 years. And so for me, it's not to say it's business as usual, but my goal for my companies that we own is for them to first drive the re-rating in their share prices by returning meaningful amounts of free cash flow. And once that's achieved, then we can talk about, you know, helping, you know, one, displace Russian oil. That's another conversation to have. And then two, meeting the growing thirst and demand for hydrocarbons, both for natural gas and for oil.
Thank you. And John, you know, same question to you. Like, where are we in carbon markets and their evolution into the future?
Yeah, you know, it's fascinating. So what we've witnessed over the last, I would say, a little less than a decade, maybe 6 or 7 years, is this, you know, as the preponderance of both the frequency and severity of these severe weather events have happened, whether that's wildfires or floods, ironically, sometimes in the same place, or, you know, hurricanes, or, you know, even ice cap glacier melt. So this summer in the Arctic, we ran a period of over a week, 40 degrees Celsius above the typical temperature there, 40 degrees above normal. So normal is below zero at that time of year, and it was up in the 30s. So, you know, it's those types of things have really grown the awareness, right? And the, you know, environmentalists who've been with us, you know, since well in the early 70s, got a much larger audience. Voters have come on board. That has shown up both in terms of governments paying more attention and, of course, investors paying more attention, right? As they've gone after corporate boards and pension plans. And the analogy I'll use to just put a framework around what Eric was talking about, imagine, so we're using oil as a global economy. Everything we use, all our plastics, all our TVs, all our transport, everything's built on our power generation. Everything is sort of based around hydrocarbons. So imagine you're going 60 miles an hour or 70 miles an hour down the 401 and you're in the passing lane, okay? And you just suddenly decide, actually, I didn't want to be going westbound the 401. I want to get off the 401. Well, I'll give you two choices. One is you jam on the brakes as hard as you can and swing hard to the right and see what happens. The other is you start thinking about the next exit, start working your way over a couple of lanes, because, you know, the 401 could be, got to get over, you know, 4 lanes into the collectors, another 3 lanes, and you're gradually slowing down. You see your exit coming up, and then when you see your exit, you move into the exit lane, you start slowing down, then you're on the ramp and you slow down and you eventually get off the freaking 401. Well, the first example is what effectively investors did, to Eric's point, when they said, you know, we don't want oil, we're not going to have oil and gas, we need to get off oil and gas, you shouldn't buy oil and gas, you shouldn't produce oil and gas, you shouldn't have pipelines. And all that has caused is $100 oil, which ironically now has a lot of those same people screaming that why aren't oil companies producing more oil? And a lot of economic, you know, uncertainty. And frankly, you know, to the Russian invasion, it's given Russia, you know, sort of leverage over Europe in terms of like, you better not do too much or else we cut off your oil and gas. So that clearly is not the right answer. The right answer is a gradual transition, thoughtful, that requires staying on the highway for a sustained period of time. So to Eric's point, you're going to need these oil and gas producers. So you might as well figure out how to do them, how to support them and make sure we have the oil and gas we need to run our economies. But do that braking and turning, providing economic incentives for industry to find new carbon-free solutions. And if it's going to be economic, these are huge investments. They're definitely going to take, to Eric's point, many decades, right? And to like, the simplest one I've never understood is cars. Right? I mean, and Tesla is, I guess, a good example of this, but yes, they've done a wonderful job of producing electric cars, but it's a rounding error on the number of cars that are needed every year and that are driven. Forget all the ones that are already owned and are being driven. It's just going to take a long time, and that's just reality unless we all decide we're going to go live in a cave. So traditional oil and gas will be here for a long time. It is an incredible investing opportunity still, and Eric has done an amazing job at working with those companies and in terms of looking at their understanding the opportunity, given their valuations, to buy back stock and raise dividends. But it's also an amazing time for carbon credits. That is the incentive that pushes people in industries to find other ways. If you gradually raise the price of carbon, that is what's going to push people to find another solution. And in Canada, we've done it, I think, backwards. I'm still happy we're doing something, which is, in Europe, for an example, they go to industry and say, here's your emissions now. They need to step down to here next year and then lower the next year, and then give them a pathway lower. And then the market sets the price of carbon, right? You might make it, you figure out how much that investment's going to cost you. And if you don't want to make it, then you're going to have to buy carbon. And so it's a market-driven model. Canada, our government prefers the sort of tax and redistribute model. So they're carbon taxing both consumers and industry. And then their plan is to redistribute it to both help people that have been displaced that were related to the fossil fuel industry, but also to help this transition. And that's where they got a lot of grief in the report this morning that, I think he cited an example where money that was supposed to go to help people displaced from fossil fuels actually went to renovate a college in Atlantic Canada and house seasonal workers. It sounded like it became a slush fund for the Liberals. And that's always the danger when governments do it. But back to that plan, it's pricing carbon right now in Canada at $50 a ton. And as a target of $170 a ton by 2030. And so just if you drove from New York to LA or Toronto to Vancouver, that would emit about a ton of carbon in your car. That if you look at where prices are now, in North America, California and Quebec are the two largest jurisdictions in North America. They're pricing carbon around $20 a ton right now. So there's still a lot of upside in carbon.
We've got a great story and opportunity. Frankly, it sounds like in front of us on both ends of the barbell. Maybe, Eric, an interesting question, and it kind of brings government and politics a bit back together as well, because the about face on our needs for oil and gas, seemingly, at least in the eyes of the average reader, quite polarizing versus where we were sitting end of last year, where everything was all green all the time. Are we and are your companies and the groups that you're working with, are they actually still investing in capacity to drive the business forward and support what is not, a flip the switch 2 years later we're ready to go, but in fact, a 30 or 40 year plan to get to the end state? Is that something that you're seeing?
No, I do think the spending on the part of oil companies really is aimed at moderating declines, keeping production flat. Because again, when companies are trading at their lowest valuations in history, and there's not an energy investor on this planet that wants these companies to grow production, they want to get paid, because we've had to endure the worst bear market in history. And so the communication from investors to companies, i.e. the owners, to the boards and the CEOs is, this is our time to get paid. And we will get paid with buybacks, we'll get paid with dividends, be them base or specials. And so you're seeing that. You referenced before the volatility and lack of thought in energy policies. We reflect on the past year. We've gone from politicians saying we should throw oil CEOs in jail for climate crimes to now begging them to increase spending on capacity, when for much of the world we rely on big projects that take 4 to 6 years or longer to bring on stream. And so you can't pivot in a day and expect immediate response. You can't vilify a sector and then come back and say, well, we need you to help us out and bail us out. As we've got a midterm coming up in the next several months, and my approval rating is being crushed because the consumer has to pay a lot more for gasoline. And so industry just needs to be, we should be championed. When I reflect on Canadian energy companies, Like, we produce natural gas and oil in the most ethical and clean manner of any hydrocarbon production in the world. We're building this pipeline that you and I and John owns as taxpayers, and we just spent $50 million to move 100 anthills, 150,000 frogs, and literally rare moss out of harm's way to later be installed. And so I dare anybody to say that we don't have, the highest environmental standards in the world and ESG standards in the world. And so that's what we're seeing from spending from companies, and the demand of owners to the boards is low to no growth, maximize free cash flow, and return that excess cash back. And we need ultimately a price signal from the equity markets and higher valuations to drive increased investment, and we need better government policy.
But within that, Eric, actually, they've also done a good job, or they've dramatically increased investments they're making in, to your point, the environmental side of their business, right? I mean, all of the Canadian majors are cooperating on carbon capture and trying to develop that technology. And they're fully aware of, to your point, Eric, where the endpoint needs to be. They're not oblivious to that. So they'll make those investments, and because that's what everyone told them they should be doing, right? What everyone was telling them up until about 2 months ago was, you should be not producing any oil, and you certainly shouldn't be looking for more oil. And by the way, if you are going to produce some oil, you should find ways to reduce the emissions, from it. And they've been doing exactly that. And it's unreasonable to expect them to do, to Eric's point, they went through a 5-year, nobody cared when they were all losing money and going bankrupt, right? Nobody. They all told them they were in the wrong business. So, it's going to take a long time to solve this problem. This is Eric's whole thesis on a super cycle. And it is what it is. If you really care about the environment, actually, then you shouldn't mind so much, because higher prices is another economic incentive for people to find alternatives. So this is just, the way it's going to work. And it's a generational opportunity in oil and gas, for sure.
And in fact, Canadian oil, if Eric, I take your statement on face value, some of the best in the world to work with, which is incredible to hear, and hopefully on brand. Maybe a good segue, because politics and government ultimately impacting a lot of what's been going on over the last 2 months, I should say. Eric, you made a quick comment about both sanctions and restrictions on oil distribution and the impact that they're going to have. Maybe timely to pull that into the conversation as well, as we think about the impact on Canadian oil.
Sure. So where I think people are not understanding is the longer term implication of Russia-Ukraine. We're seeing energy policymakers realize that oil revenue is literally being weaponized. You look at exports from Russia into the United States is about 600,000 barrels per day of oil and products. That translates to about 48 cruise missiles a day, which Russia is literally using to kill innocent kids. And so for the civilized world, I think policymakers have realized that they need to transition off of Russian crude, Russian natural gas. And again, just like the energy transition, it's not something that can happen overnight. We're in the most undersupplied market in history when we look at inventories. And so most people would say, well, we're worried about sanctions. Peace breaks out, which we all pray for, and the very next day sanctions will end and we'll just go back to normal. I don't buy that. I think what we're seeing now is a long-term transition away from Russian crude. And as the second largest net exporter in the world, that's profound in what was already a structurally undersupplied market. So we've been bullish on oil for quite a while, for a lot of the themes around chronic underinvestment, insufficient investment, energy investors not wanting the growth of production, OPEC exhausting spare capacity, et cetera. But what we're seeing, the horrors that we see occurring in Ukraine, is just solidifying and adding kind of fuel to the fire for why we're bullish on oil.
Oh, thanks, Eric. Maybe a tie-in question for you both. Like we're going to have obviously a fair bit of uncertainty in front of us, both while the war transpires, and obviously as governments move and change, and whether the vision and mission forward gets adjusted or reorganized along the way. Maybe John, starting with you, what do you see as kind of that next big catalyst event that may affect, ignite, or stabilize carbon markets? Where are you looking to in the short to medium term?
Well, I think Eric's been very, very right on energy, and I think he's going to stay right here. And to my earlier comment, the prevalence of high energy prices and traditional energy are going to add more momentum to voters to say, like, help us with this. And the natural answer that people are going to want to hear is, we don't want to be supporting Russian oil, like we should be getting off of that, but we also need a better transition plan. This is the first thing you saw out of the Biden administration, right? We have to invest more in getting off of carbon-based energy, and that's going to take decades. So to me, energy prices are going to stay high. That's going to create more impetus for a transition. And that's going to create more awareness that the price of carbon that we have is too low, right? The economic costs of it are too high. And so, the reason we love CBON as a product so much is it gives people that opportunity just to ride a completely uncorrelated asset class in a decades-long transition that we think is really, it's not fathomable to me in any reasonable time frame that people are going to decide somehow that carbon is going to be lower priced, that it's not worth much, or that there's no damage from carbon. Like everything politically, economically, even in the corporate world, people are going to realize that the price of carbon is too low and it needs to go higher.
And in fact, a small plug indeed for you. Obviously, you've got the ETF there, which makes the market very accessible, where previously, obviously, it was something that institutions, best case companies had access to prior to CBON hitting the market.
Yep. Yeah, it's just a neat, diversified way to own the global carbon futures market. So UK, Europe, California, Quebec, and then the Northeast US. Yeah.
Tremendous. Eric, thinking about yours, obviously, crystal ball can't really keep that in hand these days because everything seems to be a bit up in the air, depending on the day of the week and which media story hits the wire first. But what's kind of that short to medium term catalyst for you? War comes off, fine, that's a different journey, but I'm sure you've scenarioed out 10 or 15 different things that are of interest to your work.
Yeah, I think it's the continuation of what we're seeing now, and that is inventories are at multi-year low levels. Demand, we've got a short-term hiccup occurring in China's lockdowns, and it really is noise. I find the noise of the day distracts people from seeing what matters. And so what matters is we were back to pre-COVID levels for demand. We'll be back there in the coming months. Supply growth is structurally challenged. Inventories are falling, putting massive upwards pricing pressure on the price of oil. And when I look at energy stock valuations, we can buy companies using today's oil price and today's natural gas price, trading at 1 to 1.5 times cash flow and 30% free cash flow yields. You can go buy a large cap that just told you that in the next couple of months, they'll be paying you a dividend / buyback equivalent to 30% of the current market cap. And so when we look at the average Canadian company able to privatize and become debt-free with 3 years of free cash flow, and yet they're sitting on 15 years of reserves on average, and investors literally getting 12 years of free cash flow for free. And so we don't think there's any magical catalyst necessary. It's just the continuation of what we're in now. And we think it's going to last for many, many years because the price of oil has to go high enough to kill discretionary demand and incentivize those that are not investing to invest once again in long cycle production that takes 4 to 6 years or longer to come online. And so we think the setup is rather unbelievable. And it's only energy ignorance that is offering the ability to buy decades worth of reserves for literally nothing. And we think, we look at the average energy stock discounting and oil price in the NNRG of under $60. And we're sitting at $100 today, and we think that price is going up in the coming quarters and years.
Just one comment, Eric, on that,
yeah.
Because I find this a lot when I speak with not just investors, but people in the investment community. People get, especially with oil, more than almost anything, they get this number that are like $100 oil a barrel, and they immediately start going, well, $100 now we're going to have demand destruction. What they lose track of is, of course, $100 oil today is nothing like $100 oil in 2008, let alone in 1970 or whatever. I mean, so, and the energy intensity, as much as we still rely heavily on hydrocarbons, our energy intensity in our economy is significantly lower than it was 10, 15, 20 years ago. So the reality for demand destruction is actually energy prices have to go a lot higher. Most people remember that the peak in 2008, it was $135 a barrel, albeit briefly. that if we were trying to get to the same real cost today, it would have to be, I think it's $175 to $180 a barrel, inflation adjusted. And inflation, as we all know, is high now. And to really cause demand destruction, given the lower energy intensity, there's an argument it has to be even higher. So yeah, you can't get just caught up on the numbers. You have to keep the relative context of what those numbers mean.
I think that's a very important comment, especially for the retail investment crowd around us. You can't always read a headline and take a decision from it. I think the thesis we leave behind across all of this is do your homework, read, educate, find people who are attached, have expertise. Conversation like this today is certainly a precious set of nuggets ultimately that our consumers can listen into. Gentlemen, I know 30 minutes has a habit of ripping right by, but if there was one parting word to leave with our audience today before I wrap things up, what would that be to our investor crowd? Maybe John, first remarks from you.
Well, I actually think, you made the comment earlier that these are both interesting investment opportunities, and I actually think people can own them together. You can own, it's a great opportunity in oil and gas, and Eric's done an amazing job managing that for our investors. But they clearly, they are the largest emitters of carbon in Canada, and they're working hard to reduce that. And, that'll happen over decades. But you can own carbon credits and effectively, at least in your own mind, realize, okay, I own carbon emitting companies that are great investments, but I also own these carbon allowances, which basically allow me to emit that carbon. And that's a great investment. And they're not correlated. So it's, I think, a really unique opportunity. Eric?
Eric, over to you.
My key message, despite very, very strong performance year to date and last year, energy stock valuations remain extremely compelling. You can buy stocks trading at a quarter of what they used to trade at. And so I get excited when every company is bought into the philosophy that investors need to get paid through meaningful return of capital. And we're seeing that. We're seeing that with Q1 results, and it's only going to get better. And so when I look at valuations today, where we're literally at sector averages of 30% free cash flow yields at the current oil price, and we think oil price is going up higher in the coming quarters and years. In my mind, there's still a very significant upside ahead.
Tremendous. Well, it's probably the most encouraging thing, frankly, that I'm taking away from this is an informed audience in the room that stay the course. You've both been long-standing believers in your respective parts of the barbell. And in fact, they come together quite beautifully in the long term. John and Eric, it's been my absolute pleasure to host you both today, and hopefully the next one we do, either I'm sitting there at that boardroom table with you, or we'll certainly host you here at NEO for the same. I really appreciate you taking the time out to sit down with us digitally, share some insights with our investors and yours about this incredible long-term investment opportunity for Canadian and frankly international investors alike. I appreciate your color, candor, and opinions, and I know time is precious both to you and to those in the crowd today. So thank you again for joining me for this NEO Spotlight, and I'm very much looking forward to an update later on as things unfold, and certainly proud to be a partner with you and the Ninepoint team. To our audience, thank you very much for joining us, for lending us your eyeballs and ears over the last half hour. You've got a receptive group in John and Eric, as I'm sure you do. Don't hesitate to engage along the way. We'll make a recording of today's sessions as well and make sure we share it with the community. So again, to you both, thank you very much for joining me today, and look forward to seeing you later on.
Great to be with you.
Thank you.